The U.S. Federal Reserve, America's central bank, plays a pivotal role not only in the U.S. economy, but also in the global financial system. Its actions, particularly its monetary policy decisions, send ripples across international markets, influencing everything from interest rates to currency values. This essay will delve into how the Fed's policies reverberate through the global economy, with a specific focus on their effects on the Indian stock market. The Fed's primary tool for influencing economic activity is the federal funds rate, the interest rate at which banks lend reserves to each other overnight. By adjusting this rate, the Fed can stimulate or restrain economic growth, control inflation, and influence the value of the US dollar. These actions have significant consequences for investors around the world, including those participating in the Indian stock market. Understanding the Fed's role is crucial for investors in any market, as its decisions can create both opportunities and risks. For instance, a rate hike by the Fed can lead to a stronger US dollar, making US exports more expensive and potentially impacting the profitability of Indian companies that rely heavily on exports to the US. Conversely, a rate cut can weaken the dollar, making US goods more attractive to foreign buyers and potentially boosting the fortunes of Indian exporters. The interconnectedness of global markets means that the actions of one central bank can have far-reaching consequences, and the Fed, given the size and influence of the US economy, is a particularly powerful player. Its decisions impact everything from currency valuations to commodity prices, creating a complex web of interconnected factors that investors must navigate. One of the most significant ways the Fed influences the Indian stock market is through its impact on capital flows, the movement of money across international borders. When the Fed raises interest rates, it can make US assets more attractive to foreign investors seeking higher returns. This can lead to a surge of capital flowing into the US, often at the expense of emerging markets like India. Conversely, when the Fed lowers interest rates, it can make US assets less appealing, potentially leading to capital outflows from the US and into emerging markets in search of better yields. This ebb and flow of capital can have a dramatic impact on the Indian stock market. A surge in capital inflows can fuel a stock market rally, driving up prices and creating a sense of euphoria. However, this exuberance can be short-lived. If the Fed subsequently raises rates, it can trigger a reversal of capital flows, leading to a sharp decline in the Indian stock market as foreign investors pull their money out. This volatility underscores the importance of understanding the Fed's policy trajectory and its potential impact on capital flows. Investors in the Indian stock market need to be mindful of these global dynamics. While domestic factors play a crucial role in determining market performance, international capital flows, heavily influenced by the Fed's actions, can exert a powerful force, shaping the investment landscape. The Fed's policies also have a profound effect on currency values, creating another layer of complexity for investors in the Indian stock market. As mentioned earlier, the Fed's interest rate decisions can strengthen or weaken the US dollar. A stronger dollar can make Indian exports less competitive in the global market, potentially hurting the earnings of Indian companies that rely heavily on international sales. On the other hand, a weaker dollar can make Indian exports more attractive, boosting the profitability of these companies. The value of the Indian rupee, like any other currency, is determined by the forces of supply and demand in the foreign exchange market. When the Fed raises interest rates, it can increase demand for the dollar, leading to its appreciation against other currencies, including the rupee. Conversely, a rate cut by the Fed can weaken the dollar, causing it to depreciate against other currencies. These currency fluctuations can have a direct impact on the earnings of Indian companies, particularly those with significant exposure to international trade. Investors in the Indian stock market must carefully consider these currency dynamics. A strengthening dollar can erode the value of rupee-denominated investments, while a weakening dollar can enhance their value. Understanding the interplay between the Fed's policies, currency movements, and corporate earnings is essential for navigating the Indian stock market effectively. Beyond its direct impact on capital flows and currency values, the Fed also influences global economic sentiment. the overall mood and outlook of investors worldwide. This sentiment, often driven by perceptions of the Fed's actions and the health of the US economy, can have a significant bearing on the Indian stock market. When the Fed is perceived as being hawkish, meaning it is likely to raise interest rates, it can create a sense of uncertainty and risk aversion among global investors. This can lead to a flight to safety, with investors pulling money out of emerging markets like India and seeking refuge in less risky assets, such as US Treasury bonds. Conversely, when the Fed is seen as dovish, suggesting it is likely to keep interest rates low or even cut them, it can foster a more optimistic outlook, encouraging investors to take on more risk. This can lead to increased capital flows into emerging markets, boosting stock prices and creating a sense of buoyancy. The Fed's communication, including its policy statements and speeches by its officials, plays a crucial role in shaping global sentiment. Investors scrutinize these pronouncements for clues about the Fed's future policy stance, attempting to anticipate its next move. This constant passing of the Fed's intentions highlights its outsized influence on the global investment landscape. Section 5. Borrowing costs. The price of money. The Fed's actions also ripple through the global economy by affecting borrowing costs, the price of money for businesses and consumers. When the Fed raises interest rates, it increases the cost of borrowing for businesses in the US. This can have a knock-on effect on businesses around the world, including in India, as higher US interest rates can influence global lending rates. Increased borrowing costs can make it more expensive for Indian companies to finance their operations and investments, potentially slowing economic growth and impacting corporate earnings. Conversely, when the Fed lowers interest rates, it can reduce borrowing costs for businesses in the US and around the world, potentially stimulating economic activity and boosting corporate profitability. These changes in borrowing costs can have a significant impact on the Indian stock market. Higher borrowing costs can weigh on corporate earnings, leading to lower stock prices. Conversely, lower borrowing costs can boost earnings, potentially driving stock prices higher. Investors in the Indian stock market must be mindful of these dynamics, understanding how the Fed's policies can influence borrowing costs and ultimately impact corporate performance. The global interconnectedness of financial markets means that changes in borrowing costs in one part of the world can quickly transmit to other parts, highlighting the far-reaching consequences of the Fed's actions. Investors in the Indian stock market, therefore, cannot afford to ignore the Fed's influence on global borrowing costs. Section 6. Commodity prices, the raw material rollercoaster. The Fed's policies also have a significant impact on commodity prices, the prices of raw materials such as oil, gold, and copper, which are essential inputs for many industries. The prices of these commodities are influenced by a myriad of factors, including global supply and demand, geopolitical events, and, importantly, the value of the US dollar. As discussed earlier, the Fed's interest rate decisions can strengthen or weaken the US dollar. A stronger dollar can make commodities, which are often priced in dollars, more expensive for buyers using other currencies, potentially dampening demand and leading to lower commodity prices. Conversely, a weaker dollar can make commodities cheaper for buyers using other currencies, potentially boosting demand and driving up commodity prices. These fluctuations in commodity prices can have a direct impact on the earnings of Indian companies, particularly those in sectors heavily reliant on raw materials. For example, a rise in oil prices can squeeze the profit margins of transportation companies, while a fall in copper prices can benefit electrical equipment manufacturers. Investors in the Indian stock market must carefully consider these commodity price dynamics, understanding how the Fed's policies can influence the value of the dollar and, consequently, the prices of raw materials. This awareness is crucial for assessing the potential impact on the earnings of Indian companies and making informed investment decisions. Section 7. Intertwined factors, a complex dance. The Fed's influence on the Indian stock market is multifaceted, stemming from its impact on capital flows, currency values, global sentiment, borrowing costs, and commodity prices. These factors are intricately intertwined, creating a complex web of interrelationships that investors must navigate. For instance, a rate hike by the Fed can trigger a cascade of effects. It can strengthen the US dollar, making Indian exports less competitive. It can lead to capital outflows from emerging markets like India, depressing stock prices. It can dampen global sentiment, fostering risk aversion among investors. It can increase borrowing costs for Indian companies, squeezing their profits. And it can influence commodity prices, impacting the input costs of various industries. This complex interplay of factors underscores the need for investors in the Indian stock market to adopt a holistic perspective, considering not just domestic factors, but also the global macroeconomic environment heavily influenced by the Fed's actions. Understanding these interrelationships is crucial for identifying both risks and opportunities. For instance, a period of rising US interest rates might present challenges for some Indian companies due to higher borrowing costs and a stronger dollar, but it could also create opportunities for others, such as those benefiting from lower commodity prices. Section 8. Investor Implications: Navigating the Global Tide. The Fed's influence on the Indian stock market presents both challenges and opportunities for investors. On the one hand, it creates volatility and uncertainty, as the Fed's policy shifts can trigger sudden reversals in capital flows, currency swings, and changes in global sentiment. This volatility requires investors to be nimble and adaptable, adjusting their strategies in response to the evolving global macroeconomic landscape. On the other hand, the Fed's influence also creates opportunities. For instance, periods of low US interest rates can lead to increased capital flows into emerging markets like India, potentially fueling stock market rallies. Moreover, understanding the Fed's policy stance can provide valuable insights into potential future trends in currency values, commodity prices, and global economic growth. Investors in the Indian stock market can navigate these global tides by closely monitoring the Fed's actions, including its policy statements, speeches by its officials, and economic projections. Understanding the Fed's policy trajectory and its potential impact on the factors discussed earlier can help investors anticipate market movements and position their portfolios accordingly. Diversification, both across asset classes and geographies, can also help mitigate the risks associated with the Fed's influence. By spreading investments across different markets and sectors, investors can reduce their exposure to the volatility stemming from the Fed's actions. Section 9. The Fed's Balancing Act. The Fed faces a delicate balancing act in its quest to maintain price stability and promote maximum employment in the US. Its decisions have far-reaching consequences, not only for the US economy, but also for the global financial system. The Fed must weigh the potential impact of its actions on domestic inflation and unemployment against their potential spillover effects on international markets. This balancing act becomes particularly challenging in a world of interconnected economies and financial markets. Actions taken by the Fed to address domestic economic concerns can inadvertently create unintended consequences for other countries. For instance, a rate hike aimed at curbing US inflation could trigger capital flight from emerging markets, destabilizing their economies. The Fed's policymakers are acutely aware of these potential spillover effects and strive to communicate their intentions clearly to minimize market disruptions. However, the complexity of the global economy and the inherent unpredictability of financial markets make it impossible to fully anticipate the consequences of the Fed's actions. This uncertainty underscores the importance of ongoing dialogue and cooperation among central bankers around the world. By sharing information and coordinating their policies, central banks can attempt to mitigate the risks associated with policy spillovers and foster greater stability in the global financial system. Section 10. Conclusion: Staying ahead of the curve. The US Federal Reserve's actions have a profound impact on the global economy, including the Indian stock market. Its influence stems from its impact on capital flows, currency values, global sentiment, borrowing costs, and commodity prices. These factors are intricately intertwined, creating a complex web of interrelationships that investors must navigate. For investors in the Indian stock market, understanding the Fed's role and its potential impact on these factors is crucial for making informed investment decisions. This requires staying abreast of the Fed's policy statements, speeches by its officials, and economic projections. It also necessitates a holistic perspective, considering not just domestic factors, but also the global macroeconomic environment, heavily influenced by the Fed's actions. Navigating the complexities of the global financial system requires adaptability, vigilance, and a keen understanding of the interplay between domestic and international forces. By staying ahead of the curve, investors in the Indian stock market can mitigate risks, capitalize on opportunities, and achieve their financial goals in an increasingly interconnected world.